Today is October 17th, 2017. This is SMB's Options Tribe meeting. This is the disclaimer that we like to show folks about the fact that anything you're seeing on the screen today is hypothetical computer simulated performance results. While believed to be accurately represented, they are not subject to the market factors of liquidity, slippage, and commissions. And today, we are bringing back to the Options Tribe John Locke, who's going to be talking about his most successful option strategy of all, the Rock Options Trading Strategy, and how to transform your trading with that strategy. So, John, I am going to ask you to share your desktop and make a presentation.
Okay, we can do that. We can run right into that if you would like. So welcome, everybody. Thank you for joining us today to speak about the Rock. So let me just accept one over this, so we will move on. Just tell you a little bit about myself in case you are not familiar with who I am. I am on the options trading desk. As you know, I've developed a lot of strategies for SMB, including super simple spreads, M3, bearish butterfly, the Rock strategy, M21, and we're trading a lot of those strategies here at SMB as well. I'm also a performance and coach and a success coach for trading, and a mentor as well. We have Lock in Your Success LLC, which is a company we have. We coach both market neutral and directional traders. We provide one-on-one group training in psychology, trading performance, system development, and business skills for traders. I am a master neuro-linguistic programming practitioner. I'm a master hypnotist as well. We use that in a psychology and performance end of trading. And I'm also professionally trained as a coach, a strategic intervention coach to be more specific, with Tony Robbins. It's a Tony Robbins company. It's Robbins Medanis Training. And that, again, that's a very good coaching program. So I am professionally trained in that area. So moving forward, and we'll talk about the Rock. First of all, I like to go over what is the Rock? Well, I look at it as an increased yield market neutral trading system designed to adapt to volatility skews and normal market cycles without the need to decipher price charts and or volatility skew curve charts. Now, the Rock is and has been consistently the highest returning rules-based income strategy that I have. It's also the highest returning rule-based income strategy that I've ever seen, and not by a little bit, by far. And we see sometimes returns in the bearish butterfly, for example, in the 160 to 220 range. When you look at the bearish butterfly, you have to consider overlapping trades. If you look at the Rock trade, we have done a webinar, and let me back up a little bit. We've done a webinar virtually every Monday morning for many years now, where we trade a variety of different trades. We trade, M3, a bearish butterfly, a Rock trade, usually something from super simple spreads. And these are not back tests. They're what we call real-time simulated trades, which are very different from back testing, because with back testing, a trader knows the future, either consciously or unconsciously. He often adds subjectivity, sometimes without even knowing it, turning what would normally be losses into wins. In back testing, it's easy to hang on to those tough trades and turn the losers into winners. You get out at profitable trades before they go bad. What happens is you'll run forward in time, and if things go bad, you'll see that if there's any way within the rules that maybe you could have won or made things not as bad, and you would say something like, well, I wouldn't have done that, or I would have gotten out of that at whatever profit or loss, resulting in a big performance gap in what your back testing shows you and what your actual performance is going to be. However, with the real-time trades that we're doing, I'm making decisions without the knowledge of the future. I can't go back in time, and I can't, bias the trade to the future. And in addition to that, I'm held accountable for every decision I make. I have a couple hundred people watching me from week to week doing this, many of whom are trading the strategies live. So, I have to follow the rules. Otherwise, I get a whole bunch of traders saying, hey, you didn't follow the rules, and I'm held accountable for that. So this is very different from back testing. So anyway, we've done these real-time simulated simulated trades with the rock strategy specifically since 2013 expiration in January until today. And the 4-year average return on planned capital, not including 2017. 2017 actually has been a good year. Even with, we did take a loss in October, but even with that, I think we're still over 90% for 2017. But our average over the 4-year period is 106.28% per year. And these are not overlapping trades. They don't overlap. So they're 30 days, which makes the returns very realistic from an account perspective, which is huge when you look at those numbers. And like I said, you're not overlapping trades, so you don't need money to run 2, 4, 6. I've seen, I think, some guys doing 8 trades overlapping and 8 cycles at the same time now, which to me is absolutely crazy. I mean, that would not only drive me nuts, but it's also a little, it's going to get a little crazy when the market actually starts to act up and all 8 of those trades go bad at the same time, which does happen. I mean, we haven't seen that in the last 2 years because the market's been very nice to us, but you get the market starts to blow apart. You got 8 trades on. I mean, good luck to you. That's all I can tell you. But anyway, no overlapping trades with the rock here. So let's talk about this. The rock trade, what it does is it makes assumptions about the market based on entry. In other words, how should we get into the market based on an entry configuration test, and it positions you in what should be the best configuration for any given market skew situation. Once entered, the rock makes assumptions on how the market is changing based on price movement, and it will position or morph into different positions depending on whether the price movement is likely to result in an expansion or a contraction in volatility. Also, another aspect of this program is it's a stepping stone to the M21 strategy, which is less rules-based. It's a lot more subjective. So, again, what's in the rock for me? Returns is the highest returning rule-based strategy that I've seen. You get to learn how to manage multiple types of positions. We have broken wing butterfly profile positions, wide condor positions, narrow condor positions, low gamma positions, high gamma positions. You learn to trade close at expiration. We have butterflies within the money calls. We have butterflies without the money calls. We have broken wing butterflies, and we do scaling in positions as well. So there's a lot within this program, a lot of different configurations. And you get to discover how effective changing configurations can be in boosting returns when applied at the right time. So lots of good things there. I'm often asked, what is the best market neutral trade? And without context, which is really a question that can't be answered, right? Is it the butterfly? Is it a broken wing butterfly? Is it a condor? Is it a vertical? Well, the reality is it depends. There is no single trade configuration that works best in all market environments. Every single one of these is going to have their problematic times, and depending on what happens. So the question becomes, how do I know what configuration is best at any given time, which is a much more appropriate question, in order to maximize returns over time? Do I guess? Do I use, guessing is usually not the best idea. Do I use charting and technicals with support levels, resistance levels, and market cycles? Well, you can certainly do that. We do that in the M21 program. The challenge is that most traders that are market neutral, they got into this game because they didn't want to choose market direction necessarily. One of the things that has come into favor or come into a popular demand or whatever is looking at options pricing skew charts and trying to predict volatility skew changes. Now, if you're having trouble picking market direction, I mean, good luck determining what options volatility skews are going to do. The reality is options volatility skews and pricing changes are very dependent on two things: news, which is often very unpredictable and less predictable in charting. And the other thing that volatility is dependent on is the charting itself. And if you don't understand charting, it's very, very difficult to determine what volatility is going to do. So that's generally not going to be that beneficial to you unless you get really good at it. Like I said, once you get very good with charting, you get very good with market psychology, you can start to deal with volatility skews and stuff. Doing it other than that, it's going to be very random in as far as what your results are going to be. So if I'm not going to do that, what am I going to do? Well, you can look at the rock, right? Again, this is designed to take advantage of multiple situations by being a broken wing butterfly profile position when the market's most likely to favor a broken wing butterfly configuration, while being in a condor profile position when the market's most likely to favor condor configurations. And then it swaps back and forth between those profiles as the situation in the market changes. And how it does that is it utilizes the T+0 line profile to measure the option skew, to find out the highest probability entry, and then it adds real-time price movement once the position's entered to help you stay in the best position for the highest returns given the current market situation. And I put this together by making assumptions of what the volatility normally does with price movement as the trade moves forward. So it's pretty cool how it works and adapts.
John, we got a question that's come in, which is what's the maximum drawdown on the rock?
Well, it's going to be, we have a, well, actually, why don't we go over that when we get to the trade?
Okay.
Because we're going to be going over the trades.
Very good.
Does this thing of adapting to or having different configurations work? Well, like anything else, it works sometimes, but it certainly works enough that you know you have an edge in doing so. So really what's going on here is market skews are representative. So anytime you get a volatility skew on a chart or you look at your T+0 line, you can see that the market is in a different pricing structure for your options. So, and those skews are representative of what is currently going on in the market. Skews reveal the sentiment of the market, major players in the market, right? So the skews are going to reveal that. Your big banks, your mutual funds, your hedge funds, what are they doing? You have to realize that these people have a lot more information than we have. They have faster access to that information. They have a lot more people studying that information, and they push the market. They have a really good idea where the market's going. And when they do, they're buying options at certain levels, and they're creating a certain volatility skew. The question becomes, are they ever wrong? Of course they're wrong, because there's surprise news and things change. However, they are right more often than they're not, and that gives us an edge. And again, we can use that edge, and we can see their opinion playing out in the T+0 line. So we like to use that. The question comes up is, why is it a benefit to utilize different trade configurations? Well, you know, you can trade a very flat broken wing butterfly. You can trade an M3 style trade, which is a broken wing butterfly style trade. And that's all well and good, and you'll probably win most of the time, and the drawdowns stay relatively low, unless you lose multiple trades at a time, which can happen in any broken wing butterfly trade. But the challenge is a lot of times with the broken wing butterflies, you're not making any money. I mean, not any real money. If you consider 20% a year or something real money, then you know, these, then fine. But I mean, you're not making any real money. You're not utilizing the position the best you possibly could. And the reason that you get differences in how a broken wing butterfly reacts, or a condor, or any other trade for that matter, is because you're going to have different conditions are going to create different market conditions, or different options pricing structures are going to create a different T+0 line profile, and it's going to create trades that react completely differently in different environments. So I think most of you have seen this to some extent, but the differences can become very, very distinct. Mm-hmm. So here is an example. Okay. Same days to expiration within a day or two, and they're at approximately the same level in relation to the market. They're put on basically a year apart, once 2016, actually 3 years, once 2013. In one instance, we have a minus 87 delta, and we're paying about $8.10 for these butterflies. In another instance, we have minus 12 delta, and we're paying about $3.60 for those same butterflies. So if you look at this on an analyzed graph, we have two extremely different situations. We have this here where we have very little risk. We have a very flat t plus 0 line. You're going to have a higher theta number. You're going to have a higher negative vega number. And you are going to have a position that reacts one way. Whereas if you come over to the left, you have a lot more risk. You have a lot more gamma and a much steeper delta. These two positions, if you're using the exact same rule set, the exact same position in both of these environments, you're going to have two very different experiences. They may both win, they may both lose, I don't know, depending on what you do, but your experience trading is going to be different. And being in this position here is actually a lot higher risk than being in this particular position. And we can take advantage of these different situations by being in different configurations when we trade. So what the rock trade does is it uses a market skews entry test. And what we're trying to do is we're trying to determine if the major participants in the market are expecting a large move or if they're basically expecting the move to kind of grind up and really do nothing. And we can see that in the volatility skews. If you look at a volatility skew chart, the challenge with that is that 99% of traders who look at a volatility skew chart, the differences from option to option and what they look like are so subtle that it's difficult to make any kind of determination with that. Also, it's difficult for traders to translate what's happening on a volatility skew chart onto their actual T plus 0 line or their position graph. So we just use the position graph and we take a look at what's a delta number on a fixed position at the same day's to expiration from month to month. So on a rock trade, we generally enter 30 days to expiration. We'll take a look at a 50-point wide butterfly in the Russell. And again, you can actually do this with any type of position, and you can do it in any index. You can take a look at something that's consistent month after month, the same days to expiration, the same with wings, and just take a look at what's the thing cost and what's the delta in your position. And in this particular case, what we do in the rock trade, we take a 50-point wing symmetrical butterfly. We go about 20 points behind the market, and we ask a question: what would our delta be if Russell was at, in this case, 850 because we're using 830 shorts, so 20 points over our short strikes? What will my delta be? In this case, it's minus 281. And what we do is we take that number and we make a judgment on that based on that what type of position we should enter in. And it's going to be one of three positions. I'll show you them two. I have the examples of, I'm going to show you examples of at least one of those. We might hit two on the three examples we have. I don't remember how the second one was entered. But you'll enter in one of three ways, which at least theoretically, if what happens is, in other words, if the market is right, then you should be in the best position for your entry position for your position. Once you get entered, the rock trade is an adaptable multiple configuration position. So it may start as an M3 trade. It might even start as a condor looking trade like this. Usually it'll start as a condor that's a little bit unbalanced. And from there, as the market moves around, it is going to swap different configurations. It might swap into like a broken wing butterfly or a broken wing condor. It might be this here an M3R trade, which should look sort of familiar if you've been following trade groups now, because a lot of people are using some of the a lot of the concepts in the rock trade in some of their own trading. Could be a condor position, could be like an M3 or even a straight butterfly or broken wing condor position. So we have all these different configurations we might be in. So what I'm going to do is I'm going to go over some examples, show you how the trade works. We actually have three different situations here. We have, I think there's two winners, and I think this one's a break even, but I have an alternate trade to show you where it's a little bit different outcome. So there is a little bit of subjectivity in the rock strategy. There kind of has to be, because there are so many different things here. The good part is we're going to learn a lot about M3 here. We're going just in this example, and we're going to learn a lot about the rock trade itself. So just some background information on the rock trade. If you're going to do rock trade, it's assumed that you are proficient with the M3 trade and you understand basically how to trade a bearish butterfly. And those are assumptions or prerequisites when coming into the class. So here is what we do. We generally start 30 days to expiration. I am going to take away this entry. I'm going to come in here and I say, hey, if I were to enter a 1380 butterfly in this case, because the market's at 1404, and I just do a 10 lot here, I can, and we do this in the program, 1, 2, 3, 4, 5, and 1, 2, 3, 4, 5. If I were to just enter this, if it will give me 10, and I analyze this on an analyze graph, and I went 20 points over my long strike, so on my short strikes. So my short strikes are 1380. If I went to 1400, what will my delta be? And in this case here, it would be about minus 120. For those of you who don't look at this type of stuff, that is very, very flat delta for 30 days to expiration on a 50-point butterfly. What we're having the market is priced to move here. So I generally don't want to be in a tight condor position, or it would be a tight condor position, in my opinion, with these volatility skews, is going to have a low probability of actually winning. It might win because the market could die and or whatever, but it would have a low probability of winning. So that being the case, I'm going to enter this in something like in more of an M3 configuration. Now, the market skews are actually, and you should be learning a little bit of this in M3 if you're trading M3, the market skews are a little bit weird here. I have 138 negative delta. Usually on an M3, I'm going to do something like this to get at my delta to somewhere around 90-ish, and I'm just going to do minus 10 and minus 10. Come on. I'm in trouble with the buttons today. All right, so minus 12 and minus 8. Okay, that'll be close enough. And I'm going to stick something in here somewhere between 80 and 90 delta usually. I'm usually looking at time premium to get an idea of what that's like. So let's just hit it with like something here at 90 delta. I'm a little positive delta here. But if I look at my graph on my M3 entry here, I get a really big T+0 line sag. And generally, I don't like that. I would like to have a flatter T+0 line with maybe a little bit more downside protection when entering a typical M3 trade. So I'm not going to enter this way. And usually when I have that problem, I can try coming in here and doing a broken wing butterfly with a call. So I can do 5 and 5. And a lot of times, or maybe I'll just do a complete broken wing butterfly and do 10 down here. But a lot of times that'll straighten me out. But if the market skews are really weird, as they are here, if the market skews are really weird, it doesn't. See, I still have a really kind of an awful T+0 line here for an M3 trade. So that's just telling me that the volatility skews are just, they're kind of really out of whack. So the next thing I'll usually do is I'll try and roll a butterfly back a little bit. Instead of starting there, I'll start 10 points back. In this case, if I analyze 10 points back, I still kind of have the same problem. Even if I do a broken wing butterfly, it's better, but it's still not good. So in this instance, I end up coming all the way back to 30 points under. And I'm literally starting outside the tent on, let me clear trades. I'm literally starting outside the tent as an M3, and that's perfectly fine. This is you can start an M3 this way. So I'm 30 points or almost 40 points behind the market, a broken wing butterfly. If you analyze this, I'm outside the tent, but I have a nice flat T+0 line. I have a lot of downside protection. This is a really good entry for an M3 trade. So let's enter that way, and because again, because of the volatility skews, this is what we determine is basically the safest way to enter this particular position. Now from here, what I'm looking to do is I'm looking for those skews to change, and basically I'm going to stay in an M3 position unless I run outside of M3 parameters. So if I don't have to roll back and I don't have to roll forward, I'm basically going to trade this out as an M3 trade going forward. In the event I have to roll forward, in other words, in the M3 trade, if you're not familiar with that, if we get, say, maybe at a 1430 here, we're going to be doing a roll-up. And if I have to do a roll-up, I'm going to recheck to see what the skews are to see if I should roll up into another M3 like this, or if I should roll up into maybe some sort of a condor configuration. And let me get my notes up here. I just have to go through to see what my adjustment dates are. And I'm just going to kind of go from adjustment to adjustment. So let me move up, and I can just go to the 22nd. So I was 30 days to expiration. I went 7 days. Now I'm 23. And if I look at this, again, standard M3 guidelines, nothing's really happened here. The market's just been kind of flat. And I'm going outside my delta guidelines. So I'm just going to throw some verticals in here at 1360, 1370. Okay, standard M3 adjustment, get my delta down. And now I'm in a position like this. And let's just go to the next one here, the 27th. All right, market's taking off to the upside again. Again, I'm starting to have a bit of a delta issue. And this is what the position looks like here. We're holding value, but certainly not setting the world on fire here. I just did 5 more, 1360, 1370 verticals, bring my delta down. End up in a position like this. Again, this is typical M3 stuff. We'll get into more rock stuff on the second trade. This should go fairly quick. Okay, let's see. So from here, the market's down, but still we're up $1,200. We are now 15 days to expiration. We're 63 delta outside the tent. Again, that's typically a little bit high on an M3. We'll just cut that back a little bit. We end up in a position that looks like this. And then let's just go to the next, March 7th. What have I done here? All I did is I rolled up. This is by the way, this is the website trade that we did on the website trade. So this is the actual website trade. Mm-hmm. And I simply, this was just a capital reduction thing. What happens sometimes is you get your call, if you have a deep in the money call, you can see that the market went up so much, or the time went by, and we're at 1190 with our call, and we're taking on basically all this risk from 1310 down for no credit. So a lot of times we'll roll these up. So he's rolled this up into here, and here's what the position looks like there. So it's a capital, just capital preservation issue. 3.8. And it also takes some risk out of the picture, right? So 3.8 here, we have, what do we got going on here? Let's see, analyze. Very likely during the trade, we had let me go back a day and forward a day. This happens sometimes in option view. $490. Okay. So yeah, so we're showing a delta issue here with the pullback, and of course we want to make a correction for that. And what we did is we just rolled back the upper wing. So we went from, this was the position we started with, and we roll back the upper wing. Again, this is typical M3 type of stuff. Let me close this out and open it up again. We're having a little bit of bugginess here in option view. That looks better. We bring our delta down to positive 25, and we run into this position here. So we went from, let me undo this position back to this position. So we're rolling back the upper wing. You can see we pull the upside risk out. Or again, this is M3 stuff, but this is kind of a little bit maybe more advanced M3 stuff than maybe some of you have seen. And again, this flattens your T+0 line. And of course, from here, I think there is maybe just an exit. Let's go to the next trade.
So this essentially, your entry rules dictated you be in an M3 trade. Nothing changed, and so you just adjusted it according to M3 guidelines, essentially?
Exactly.
Right. Okay.
Notice what we're doing here with even with the M3, right? We are, again, we're having a positive delta issue. We're up money, and we're just rolling back that upper wing to correct the delta and not really affect our downside risk, right? So we took the upper wing back a little bit more. Again, we brought our delta within parameters here, and now we're like this. So we don't get hit with the reversal. And a lot of challenges people have with the M3 is they roll back and they let their upside go, and that can be problematic sometimes. So anyway, so we'll just complete this out because this is essentially going to close out as an M3 trade. What did we have here? We had a market reversal, right? So we went to here. We dropped back outside the tent with the market gain. So we're going to start adjusting back up again. And we do that. You can see we're going to take the shorts forward, which is, again, typical M3 adjustment. That's going to put us into here. And then I think the next move here is closing this. Now, let me talk about the risk parameters because I was asked about that. So we closed the trade the following day, and 3 days to expiration. And this is what we look like 3 days to expiration. Again, we exceeded profit target in this configuration. So this here is the demonstration we did is a $50,000 planned capital trade. It has a 20% profit target, which is $10,000. It has a 20% maximum loss, which is $10,000. In M3 configuration, it's almost impossible to get drawn down that much. In fact, if you're in M3 configuration, you only have a 10% drawdown allowance. So in other words, the profit target and your maximum loss are going to change depending on what configuration you're in. So if I'm in M3 configuration here, it's pretty much the same as a standard M3, up 10%, down 10%, unless the drawdown was initially caused by a ROT configuration. But it's going to be generally if you're running through an M3 like this particular trade, then you're going to have, again, the 10%. Once you get up into an aggressive configuration, as in ROT positioning, we run a 20% profit target number. Okay, and we allow a little bit more of a maximum loss because of that. So that was one position there. We close this out. Let's show something a little bit more interesting. And let's go to our April position, which is 3/22/17 is the date. So we close this trade out here. We're basically out of the market until the 22nd, which is the next 30 days to expiration. So you do spend some time out of the market in this trade. And I have to go to another account, which is here. We did the entry test. We once again went into an M3 configuration to start because of the way the market was skewed. We are, in this case, we also have a T+0 line issue. For whatever reason, I don't remember. I just decided to enter it this way. I thought that was acceptable in this case. Like I said, we did this on the website. And let's just move forward with this. So let me go to our first adjustment, which is on the 28th here. So if we take that out, Again, this is typical M3 stuff. We're outside the tent. We're over minus 50 delta. We roll up some short strikes here. We bring our delta back in line. We run into something like this. Let's move on. 30th, I think we may have done a conversion here. We did. So let's take a look at the situation here. We are more than 10 points over our upper long strikes. We are positive vega. We're negative delta. Normally in an M3 situation, this is going to cause a roll up. And we would just take the position off. We would roll it up. What we do in the rock trade instead is we take a look and we do that same entry test. We do that 50-point wing butterfly at 1360. We take a look at what the delta is. We make a determination of how we should go into the market. And sometimes we're right, sometimes we're wrong. Most of the times we're right. Not in this case. But anyway, what we did end up doing here is we close out the M3 position. We come in somewhere between 10 and 25 points under the money here. We put on 10 butterflies at that price, and then we go 40 points higher, and we add butterflies at 1,400 until we bring our delta down to somewhere around minus 180, and we end up in this position here. Now, this is also would be a starting position for the trade, 30 days to expiration if you had really steep skews in the marketplace. In other words, if we initially did our entry test and we had say 200 delta, minus 200 delta or more, then we're going to actually start in something like this. So this case here, we rolled up to something like this, with the theory being that the market went up quite a bit, and typically, or a lot of the time, was when the market goes up, they go up and then run sideways, and this gives us some downside protection here. The market stalls. We have an awful lot of theta working for us. It gains money very quickly. If the market grinds up, we aggressively enter into this part of the position, and then we go 20 points higher, and we aggressively enter into that. And we have, like I said, delta limits and so forth that put us to that. So,
John, we've got a couple questions.
Sure.
One is, does the course describe why you decided at this point in time to transform this from the M3 to the rock structure?
Yes, it has very distinct rules for that.
Okay, good. So that'll come out in the rule set in the course. And then secondly, Luis is asking, if the rock is traded as an M3, do you reduce the profit target from 20% to 10%, or does it remain 20%?
Well, that we do. Exactly. So we're going to run a reduced profit target as long as we're in the M3 configuration. So at the beginning of this trade, when we started out as an M3. We had a 10% profit target. We're now in rock position. We now have a 20% profit target. So we're getting more aggressive with the trade now.
Gotcha.
And we want more money. Although I will sometimes, and you'll know this in the market environment and the market updates when we do these on Mondays, if I'm drawn down significantly, then a lot of times I'll take my drawdown off my profit target. So in other words, my profit target now is 10,000, but a lot of times, if I'm drawing down 1,000, I'm not worried about it. But if for some reason I get drawn down $5,000, $6,000, $7,000, $8,000, I'll start reducing my profit target down.
Okay.
Okay. So let's go forward. We'll see what happens. So we come here and the market goes up, right? We have a delta limit here around minus 250 to do something. We're drawing down $3,000, and the market kept going up. So it was going up faster than we would like it to. So we do get drawn down when we're in a high gamma position. So what we do is we make corrections. I'm going to fully scale into these 1,400 butterflies, and then I'm going to start scaling into some of these 1,420s to get my delta down to normal. So you can see that we added the butterflies here at 1,400. We added 2 at 1,420, and now we're in this position here. One of the things you'll see about this is as soon as the market stalls, it recovers extremely quickly, particularly in this position. The market's not going to stall on this trade, but if it were to stall, it does. So let's go forward here to the 3rd of April. And what happened is the market started coming down on us. So We don't allow a whole lot of positive delta in this thing. This is where we stand. So we're going to start cutting back out of our upper butterflies. In other words, the position kind of rocks back and forth, right? So we pull off these 4 butterflies here, 1420, brings us down to an acceptable delta limit. And let's just move forward, I think, to the next day. And the market comes down again. So now we are, again, over our maximum delta numbers. This is where things get a little bit subjective. When we start coming down like this, we have several options available to us. And it's done for multiple reasons. One of them is to help you try to decide how to make better decisions and to give you a little bit of subjectivity and workability with the trade. We could either pull out of some of our 1400s to bring our delta down to normal, or we could go back into one of the other configurations called a cat configuration. In the website trade, we rolled back into cat configuration, which turned out not to be the optimal choice. But like I said, when you're doing this real time, you have to make a decision not knowing what the future is going to do. So this is a trade configuration that has its own set of rules. It's completely different from, so you have your M3 configuration with your M3 rules, you have your rock configuration with your rock rules, and you have cat configuration with cat rules, and we have actually a total of 7 configurations. So all with their independent rule sets. And this is going to be traded a little bit differently. So this is what we did here. We brought this back again. When I go back into cat configuration, I'm dropping my profit targets down. This is not as an aggressive as a position as the other ones. So moving forward here, right, we continue to drop down. I ended up closing the trade out on the 13th. So what happened from here is the market went down. We got into a position where we had to switch into a different configuration. I decided at the time to simply close the trade down. We do have other options that you could do here. You could go into what we call M3R configuration from here. And I'm going to show you that because that was the other option that we had with the trade. So I ended up going here. I ended up closing this trade. Basically, it was due for a configuration switch. I was 8 days to expiration. I didn't like what the market was doing. So I just decided, and I didn't like really my positioning here, so we just decided to leave at a small relative loss. Let's go back and look at when we roll back into cat position and take a look at the other option that we had available to us, and just to demonstrate the other configuration on the trade. Mm-hmm. So let me go back on my trade log.
So this was a trader's choice situation.
Yep.
And this is, you're going to show us another possible choice that could have been made.
Right, which is the other choice that could have been made here. So this is when we swap back into, this is the situation we were in. Let me go back. I'm just going to go to this account here. Right, same position, same situation. We're due for a rollback. The other thing that we can do here is we can drop into, we call it rock half entered. So I drop out of these 5 butterflies, and I'm essentially back into my entry position again. Oh no, I'm not. I rolled back too. So let me go back. All right, I did both. So so what I did here is not only did I drop out of my upper butterflies, but that wasn't enough of a delta correction. So what I did is I rolled back these. So in both the other example, where I just rolled straight back into cat position. This example here, I went into what we call M3R position. Again, this is its own configuration, its own special rules are all outlined in the program, what the rules are. But I go into an M3R configuration, and that looks like this. Okay, and I'm just going to widen this out so you can see exactly what it looks like. This can be done with butterfly calls. It can also be done with broken wing butterflies. But this has its own rule set. It's also its own trade, by the way, that we have. It's called an M3R trade, where you actually enter this way. But this is what that looks like. Let's just go forward. We'll show you how this one happens to be adjusted in this situation. And like I said, this would have been the better choice here. The cat position is generally a better choice if the market stalls. The M3R is the better choice if the market continues to tank down. So, all right, so we came down. We're over maximum delta. Our M3R maximum delta is positive 50, by the way, as it is with the M3 trade. And also I'm going to do is I'm going to continue to drop out of these butterflies up top here. So I'm dropping out of some of those to make a delta correction. So actually just one of them. So here is the resultant position. I just dropped out of some more of these. If we go to the 10th, which is our next adjustment point, okay, and let's see here. This ends up in this position. What am I doing here? That shouldn't happen. Let me see. I may have made let me fix this T-log here. We'll just play this out by rules if that was in error. I think it was. Ah, there we go. Okay. So this is our position here as of, let me get this now that all the trades are included. This is our position here. Again, we use similar delta guidelines as we do with a regular M3 trade. We're over our maximum negative delta. We do our regular thing here. We do 10 verticals and put us to minus 37 delta, put us in a position that looks like so. Again, we have a $50,000 capital limit here on this particular position. Moving forward. Okay, the market came back down again. We are basically at break even now. Too much positive delta, dropping out of some of these upper butterflies. And we go into a position that looks like this. Okay. And then from here, we go to the 17th. We are up $3,900. However, our delta number is insanely high. So I need to make corrections for that. I roll back my upper long strikes. So I go from here. And again, these are all techniques you can use in M3. You're up money. You have too much upside risk. You want to strike a delta correction. You move in the upper long strikes, and right, that brings us to minus 55, which is within guidelines for that. And you're in a position that looks like that. And then I think on the 18th, possibly, this may have. Let's see what happened here. Again, we have a negative delta issue, and we're up at $3,500 in a position that looks like that. And what we're going to do here is correct the negative delta issue. I think rolling back more upper longs, right? Yep, I did that. Took 4 out of the 1370s, brought them to 1360, ran into this position here. And again, you're going to be running a 10% profit target on this particular configuration here. We run 2 days into, yeah. Right. We run into 2 days to expiration, and we are again 2 negative delta to the upside, and we're in this position here. We make adjustments to that. Again, I think we probably rolled back uppers. Let me see what we did here. Yeah, we rolled back some of the uppers, brought us to minus 19, put us in a position that looks like this. And, now we get a blow off to the upside. We're doing pretty well, and we have a decent downside here coming into the following day. Right, market blows up 15 points. We're up 46.60. So almost a profit target, which you could close the position, but if you didn't close the position, you have too much positive delta, and you'd have to get that down. And I believe I just sold my deep in the money call, and that pulls my delta down. I don't know if I did anything else here. Yeah, I sold that, and I sold part of the butterfly spread. So I had a deep in the money call here, and I had a vertical here that I got rid of. All right, so we closed that out. Brought us to minus 61 delta, which is not crazy, and it puts us in a position looks like this. So this is a fairly safe position to expire. I have maybe a bonus situation if the market goes down, and realistically, my upside risk is fairly limited. I'd have to have a monster move to really. I can't get hurt too bad. So
yeah, it's like going to settle the next morning. I mean, how much is it going to gap open or?
Well, I mean, it can gap to 30, 40 points, but right. I mean, even so, it's not going to hurt me a whole lot. So
no.
Definitely worth staying overnight, something like that. And that would be the alternative. That would be the alternative structure that the trader could have made with that, depending on their decision of what the market was going to do. Again, I was thinking the market would probably lay flat, but that didn't happen. And so I went to a cap position. It took a small loss, but again, this could have worked out either way.
John, let me ask you a question. So was this? Yeah. I'm sorry, you were going to wrap up this trade?
Oh, no, it's all set. Yeah, it's all done.
Yeah.
Because
okay,
it's just going to expire.
Yeah. The question is, was your next example critical for everyone's understanding, or?
I don't think so, because we got most of the configurations in. I think the other one, the next example, was an M3 that went into rock configuration. I think it pulled a 20% profit. So it was a just an example of how kind of what we saw already. But yeah, if we're short on time, then that's fine. Yep.
Well, I think it depends. What I want to do, here's what we can do. What I want to do is talk about the special we're doing on the rock this month, and then if folks want to stay for that final example, and you have the time for it, John,
okay.
We can do it that way. So let's do that. So I am going to take over the screen for a minute, sure. And what I'm going to do is talk about. Everyone can see my screen now. Is that right?
I can see your screen. Yep.
Okay, great. So guess what, John?
What?
It's Rocktoberfest. And
it is Rocktoberfest.
You notice how we take the rock and we put it into October, and it just becomes Rocktoberfest. And so what do we do at Rocktoberfest, John? We put the rock program. We have specials involving the rock program, and we actually have a special on the special this month. So pay attention. First of all, the rock online course is 7 on-demand videos, 408 information-packed slides. I sat in on this every minute of this when it was first taped. It's an unbelievable amount of information, like a treasure trove of options trading wisdom. It's tremendous. And of course, it goes through all of the transitional formations of the rock and so forth. And it's just fascinating. It's a great, great course. Normally, it costs $14.95 until November 1st. Till the end of October, the rock is on sale for $13.45 if you already own the bearish butterfly and the M3. If you only own the M3, but you don't own the bearish butterfly, then you should buy that with the rock. And we're putting that combination on sale for $19.50 this month. It's normally $21.90. Now, if you own the bearish butterfly and you want to get the rock, and you want to get some good knowledge on the M3 at the same time because it's inherent in the rock strategy, then you would buy the third combination, the rock and the M3, for $23.75. Normally, the price is $26.40. And finally, if you don't own any of John's stuff and you are intrigued by the rock, which I think you should be, then you can buy the entire package, rock, M3, and bearish butterfly, for a really nice savings. It's normally $32.90. We're going to get you down below $3,000 to $29.50 for that combination. Plus, if you order during this period before November 1, you get to attend a live online seminar in which John is going to be presenting advanced rock options position transition concepts. Did you notice how the trade can morph from an M3 into a rock formation, into a cat formation, into an M3R, etc. John will be discussing all of that in an advanced way in the webinar on November 27th at 4:30 p.m. Eastern Time. If you buy the course during this period, you will be able to attend that webinar live, ask questions, and participate. So it's a really, really valuable bonus that you get if you buy the series or any combination involving the series during Rocktoberfest. So please take heed of that. The pricing advantage and the offer for the advanced transition seminar ends on November 1st, 2017. So you want to act quickly. The way to act quickly is you go to smbu.com/rock. And that will give you all the information you need to know to order the course, or you can go to optionstribe.com, go to the training tab, click on Rock, and then you will be able to see that same webpage. It will take you to the same place. Before we turn back to John, I just want to congratulate all of the leaders of the Options Tribe Trading Contest through the end of September. We announced these folks last time, but I want to give them another, their moments of glory here. My favorite name this year is Pop Tart of Doom, who shows up on all three of the leaderboards this year. So he's doing great, as are all of the leaders, of course. I'd like you to consider joining the Options Tribe today. By the way, any of the alternatives we gave you, any of the packages, if you are a premium member of optionstribe.com, you will get 5% further off of that price. So that's a really strong, if you're interested in the Rock, that's a very strong motivation to go ahead and join optionstribe.com. The way you do that is you go to the Join tab of optionstribe.com and click through. It's only $30 a month, so it's a really good deal, in my humble opinion. Next week, we will be having Steve Lentz of Option View Systems International. Steve's always great. By the way, he's the mayor of a town out in Illinois, which I think is amazing. And I don't know if you realize that, but he is he's the mayor of some suburban Chicago town. And he was in an election. He's gotten in the news for a bunch of reasons, and he won the election by 5 votes. 5 votes. Now, I mean, we're not talking about the U.S. size population, but it's still a reasonable sized town with thousands of people, and he won by 5 votes. So it was a nail biter. I was actually on the phone with him that night, and he got back to me and he told me what the outcome was. It was really interesting. So anyway, that is it. Now, John, so what I'm going to say to everybody is you are welcome to stay. Let me first ask, do others want John to go over this third? Do we have demand for that? I don't, folks don't want to. Yeah, okay, we're getting quick and many yeses, John. So everyone wants to see the third option. So those of you who can stay, I know we're past our normal time, but we'd love you to stay and take another look at John's example. You can do that. So, John, you can take over the screen now.
Okay, I'll try not to spend too much time here.
No. Take all the time you need. These folks are staying for extra credit.
All right. Sounds great.
We do have a couple questions perhaps you can answer before the next example.
Sure.
Okay. Casey's asking, if you bring your long strikes closer to your shorts later in the trade to reduce risk, would you still use the standard Rock guidelines from that point on?
You have to be aware, okay? So you have to be aware that rolling in your long strikes on the edges are going to change the delta characteristics of the trade because you're making the position smaller. So you're generally going to want to adjust faster. So what I'll do is I'll roll in the long strikes and I'll monitor the position as if it had the strikes wider, and I'll make my decision off what the original trade's doing. Does that make sense?
Yes, it does.
Okay.
And, okay, thank you, Casey. All right, Dave Stewart is asking, don't you usually have the single long call in the M3R configuration? Or no, he said you don't usually have it, do you? I asked it backwards.
In the program, I do have it, I believe, in that configuration, and I actually haven't actually watched the program in a while, so it can be done either with or without the long call. And again, that's another subjective thing with the trader. In other words, you can do the whole trade without a long call. By the way, you can do a M3U broken wing condor or an M3U broken wing butterfly, and you can control everything with broken wing butterflies. Again, that aspect of it isn't in the program because I don't want to confuse people. But if you've ever seen a trade called a white rhino, a M3R looks a lot like a white rhino trade. And it looks a lot like that because what you're going to have is a set of broken wing butterflies behind the market, a set of broken wing butterflies essentially at or in front of the market. So it can be done either with the call or without the call. And I think we may have touched on that in APM squared, but I know I do that a lot in one-on-one coaching. We go to another level. Maybe we'll talk about that in the bonus webinar. We go to another level where we sometimes do the butterfly with the call, sometimes we do it without the call, and sometimes we run into broken wing, either butterflies or condors, depending on certain conditions. But I mean, you can get really into this and take it pretty much as far as you want. It's a really cool system.
Okay, and Roger's asking, the rock course has been available for a while. If there's a fine tuning that takes place, are those updates included in the course? And I think I can answer that, Roger, which is yes, we're intending to put the within the course, we are intending to put the live webinar that's going to be taking place on November 27th, for one thing.
Or any live updates. Yeah, any live updates we do.
That's right. Yeah, anything. Every once in a while, John will shoot a supplemental video or send in another PowerPoint with some updated information that we then share with everybody and add it to the curriculum. Casey is asking, do you look up and down 30 points to make sure you don't hit max loss later in the trade?
I usually don't know. However, you can incorporate that into your trading plan, right? So, one of the things we talk about a lot of times in some of the other webinars and some of the other programs is we start talking about catastrophic risk management, and depending on the reason we don't necessarily put it in this program is in the basic programs is one, because it tends to confuse people, and is just another aspect. I mean, sometimes these can be confusing enough for some people, so it's just another aspect. But you really should be applying that to all your trading, depending on your position size. So somebody might be trading a rock trade, for example, and they might be trading 0.22% of their net worth. In which case, if you take a huge loss on the trade, it's not a big deal. But if you're trading a rock trade with 20% of your net worth or something like that, I mean, you have to start bringing risk control management into your trading. Otherwise, you are risking a fairly large loss with a large move, and that goes with anything you come in close to expiration with. So, again, it's going to be a situation that is going to vary from person to person, depending on their situation, depending on how much of their net worth they're trading, and how speculative they are in general with their trading. And that's definitely something to consider, though. Yeah.
All right, John, that wraps up the questions. Oh,
okay, super.
Yeah, okay.
All right, so this is the May. It's 4/19/2017, and I don't remember exactly how this one turns out. So, but let's take a look. So 4/19, yeah, 4/19/17. Let's go into this here. I don't know why this is showing overlap. It shouldn't do that. This is May, rock trade. Okay. So this was apparently once again entered as an M3. That's one of the weird things about the volatility skews earlier this year in 2017. It's very odd. We had very low. This is why you can't just go off of a RVX number or a VIX number either. We had relatively low volatility, yet the options pricing skew curve was such that butterflies were really cheap. which is why I think we had some outstanding performance earlier this year, like I've never seen before. It's just really good. And I think that's why that happened. It's just it's kind of unusual. But anyway, this is the way we entered it, and I don't know why it is showing me down $400 on entry, but we will go with it. That does happen sometimes live, so you can get
Yes, it does.
Yeah, you can get stuff far from mid pricing sometimes.
Right.
Anyway, this is our entry position. This is what it looks like. Standard M3 positioning. So let's move forward here. This is Vega problem. So I have a Vega issue. Generally standard M3 guidelines, right? I'm usually not going to roll up an M3 if I am less than 10 points over my upper long strike. And I'm less than 10 points over here. I'm only around 10 points over. Usually if I do that, I'm just going to make a Vega correction. And here, that's what I did. I just sold 10 verticals. And that is what the position looks like afterwards. Let's see what it looks like before. Okay, so that's before and that's after. Okay, let's move forward here. I did a roll-up. Now, that is interesting. Okay, so let's see what we did here. Oh, no, I didn't. Okay. So, yeah, okay. So what we did here is now with the additional up move here, we're well past 10 points over. And this just lost the call probably. Option view probably lost the call. This wouldn't be drawn down 4,700. Probably, I think it's probably about break even. I'm not going to go searching for it because I don't want to waste the time. But anyway, I'm more than 10 points past my long strike, so I'm just going to close the M3 position. I'm going to roll up around 20 points-ish behind the market. I'm going to go 40 points higher. I'm going to add 5 butterflies up there. This one here, in this case, it brings me to a delta of minus 141. There are times when I might add, again, there's a little bit of subjectivity here. I like to have 10 and 5 when I transition into rock trade, although sometimes the delta line guidelines tell me to transition. And when I do, my delta is a little bit flatter than normal, and that's okay. So I'm usually going to keep it there because I want to get 5. There are times I'll do 3 if it's really, really flat, but minus 141 is reasonable. So we transition into this position here with the expectation the market's going to flatten out a little bit. So let's go to the following day. Apparently it kept going. Right, so we get another 14-point day. Again, you draw down quickly in a tight condor, which is essentially what we had. So you want to make your corrections. Again, this would have been over minus 250. If I run option view forward and back, it's probably going to show you that. One of the things with option view you should know as you are back trading or live trading or doing whatever with this thing, you have to go backwards and forward into the date. And sometimes when you click and unclick this here, it gives you some weird numbers. So anyway, this hit a delta trigger, and what you end up doing here is scaling in to your other 5. Now, if I scale in at 1430, one of the things that's going to happen if I'm at the money is at the money butterflies are negative delta. So it's actually going to put me more negative delta than I am now. That being the case, we're just going to fully scale into these. We're going to start to go into our 1450s. So this is what we look like now. And I end up going fully into the 1430s. I buy 3 1450s. It brings me down to about minus 180. That's the numbers we're generally running here. Puts me in a position like this. Again, this type of position tends to recover very quickly close to expiration. Let's see, we're 23 days to expiration. Let's see where this goes. So you do have to put that. You do have to put up with a little bit of drawdown. Okay. So from here, the market backed off, right? Now we are having a little bit of trouble to the downside, and that does happen with this trade. So you have, like I said, it rocks back and forth. So I'm going to end up pulling out of my upper butterflies, at least some of them. With this here, I also, same thing, I had, again, this is one of the website trades. I made the decisions real time. I have the opportunity where I could have held this here and rolled back my lower butterflies and gone into cat position. But I chose instead to drop out of the upper butterflies here. And going to the next date. We start running into delta issues again. So here again, we have a little bit of subjectivity. And this is actually a third option, which is why I wanted to show it to you. And I try to rotate through the different options too on the website as we're doing the examples, because I wanted to show you the different ways you can deal with this. So I have the option of rolling back into M3R, or I have the option of dropping out of more butterflies here. I also have an option of doing something what we call reverse rock. So if I'm going to go drop back into like a cat position, a lot of times I'll just start adding some of the butterflies at 1370, since that's what we do anyway. So if I'm going to go into cat position, if I went directly into there, I would sell out all my 1390s and I get fully scaled into my 1370s. And I'd probably add these two butterflies back in as well to be into a regular position like that. But instead, what I often do, these butterflies here, they're not really in any trouble, right? These are still negative delta. If the market continues to come down, it's not really going to be a big deal. Realistically, these butterflies don't run into trouble till about 1370. So I'm not overly afraid of it. Now, if I was at 1380, I might start to get concerned, but realistically here, I just want to make a delta correction. If I'm considering going into cat position or doing the rollback, one of the things I can do is I can just start adding in back here to straighten my delta out. And that's what I did in this particular case. Okay, so I just added two butterflies. I got myself down to a reasonable delta number here. And I went into something like this. So I went from, and you saw how fast this recovered too. It was down $2,000, now it's up $2,000. So I went from something like this, which is taking on a little bit too much heat to the downside, into something like this that has corrected that. Okay, so let me close that. And if this continues down, basically when this gets to about 1380-ish or under 1375, I'll just drop out of these upper butterflies and we'll roll back into an M3R or a cat position, depending on what the delta is giving us, right? So let's move forward. We'll see where this goes. Okay, we dropped another $9. Our delta is too positive. I continue to add in here. I add in another two butterflies here, brings us to positive 29 delta, brings us into a position that looks like this. Okay, very high gamma position, yes. Basically, we stay in that position till the 10th. Oh, and it closes, right? So there were no further adjustments triggered in the trade. From the last adjustment to this adjustment, we come in 9 days to expiration. We are at our high profit target and we get out. And that was a full profit trade. Again, we could have also, and made other choices here. We could have come in here and gone into cat position. We could have also gone into that M3R position, both of which would have lowered profit targets. And I think I usually trade these out in every configuration every month. So we do something called trade debriefs. We come in and we review the trades. So usually when I do a rock trade, I'll come in, I'll debrief the trade, and if I have alternate adjustments, I would have done an M3R, I would have done a cat position just to see how they would have turned out. And I believe in this particular case, they both turned out fine, but it would have been a $5,000 gain instead of a $10,000. Going into reverse rock, I'm holding my high profit targets. So that is that example. So that was probably the best trade of the year, actually, that we've done. It was I don't think there were too many profit targets, but we had a lot of wins this year.
You're saying on the rock?
Yeah, on the rock. Yeah,
right.
On the rock. Yeah.
And the website return for 2017 is what, John?
I have to look. For 2017
to date.
Well, through I actually have to look at the sheet, but it's I have 92.
Mm-hmm.
I'm not sure if that's including we had a loss in September, so, not in September and October, so I'm not sure if that includes that or not. So it's at least
I'm thinking
70.
it does. I'm thinking that it does, but sorry,
it's at least 70.
Yeah, right.
Okay, and that's without overlapping trades.
Right, and that's through 10 full months.
Right.
So yeah. That's a light year on the rock.
I mean 2016 was the roughest year we've ever had in this trade. It was like a 20-something% return for the year. And it was a challenging year. We had some wins, we had some losses, and it swapped back and forth. But you get a year like 2013, we did 177.
Right.
So
yeah.
I mean, generally it runs around 100. In back testing before 2013 and also in our real-time trading since 2013, it generally runs around 100. 2016, again, it was a challenging year for that, but still, you look at an M3 trade, which did like 48%. That's with overlapping trades, though. You cut it back for the overlap, and it's at 24, right? And so it's about the same, even though we did the rock, even though it had a really, really bad year, it's still performing at least that good. Many times, you're up, like I said, average over 4 years is 106.28, and that might go up a little bit or down a little bit this year. We'll have to see how the rest of the year pans out.
Very good. Well, I want to remind everyone that, 1 second, I want to remind everybody that if they found this interesting and informative and inspiring, then you just go to smbu.com/rock and you will be able to get this great deal on the 4 different combinations that we're selling. And don't forget the advanced rock options position transition webinar that you'll get to be able to participate in November 27th at 4:30 p.m. All people who own the rock already are invited to that webinar. By the way, you will get an invitation. You're in our system. If somehow something happened and you don't get an invitation, just let me know and we will get it right out to you. But that's not going to happen for over a month. That's going to be about 6 weeks from now. But because we want people who do not own the program or want to rewatch it if you own it, to get yourself familiar with the program. So then when you attend the webinar, you're a smart observer. So John, thank you, especially for your overtime. I consider this an overtime win. And thanks, everybody, for attending the Rock Options webinar. We will see you next week for Steve Lentz. Thanks, and everybody have a great night.
Thank you, everybody.
Thanks, John.
Yeah, bye.
Bye.